Hello, everybody. Thank you for being here. We are doing a fun info session today all around preparing for the end of financial year. I'm just going to give everyone a moment to connect their audio and be able to join us. So today is a informal discussion around the end of financial year. I will be dropping links into the chat. There will be a document going up with this recording as well because of the time difference. We've not going to have the same amount of people that were attending prior. So if you have any questions at all, drop them in the chat and Michael and myself and Delaney will be able to answer that. So I'm going to hand over to Michael. And we're very fortunate to have him here because he's on paternity leave at the moment. He welcomed a new baby girl to his family. So thanks for being here, Michael.
Thanks, Laura. Yeah, as you suggested, a bit over a week now, paternity leave. We've welcomed a beautiful daughter into the world. So it's been a bit of a challenge with some sleepless nights, but it's all part of the fun, I guess. So yeah, thanks for having me. Look, I have to be honest, I've quickly whipped up some notes this morning, focusing on some main areas to discuss pre-30 June. The main purpose of this session is to really highlight specific ATO focus areas for this financial year, so that everyone is across what they'll be looking at. Obviously not exhaustive, but you know they've reached out and told our professional bodies and all the platforms what they'll be targeting above everything else. So off the back of COVID, the ATO is back online, doing their thing. So we all got to be wary of it and make sure we're doing the right thing. So the three ATO focus areas or main points that they've voiced recently are work-related expenses, rental properties, and also crypto or digital assets is a big one. So with work-related expenses, I guess the biggest mistakes that we see is people basically coming to us and saying, hey, let's just copy and paste deductions from last year. The ATO have basically said that's a big no-no. They're using now data analytics and systems in place to pick up on people doing this. So if you're essentially mimicking what you've claimed the year before, you're essentially identifying that what you're doing is just made up and it could be invalid, so you would be potentially targeted. Record keeping, or lack thereof, I should say. So people think we can just make deductions up sometimes or put in whatever's the minimum, this so-called myth. So what I'll do, Laura, can you please bring up the ATO My Deductions guideline? By the way, yeah, apologies, I haven't created any slides for this session, but I've given my notes to the team, so after recording, you'll get a copy of those as well. So in here, I'm not sure if people are aware, but the ATO have got some pretty useful resources and tools for deductions and deductions tracking. So in here, there's an app. If you scroll down, Laura, it's called My Deductions. There's a video there. You can have a look in your own time. Essentially, this is a good tracking tool for individuals, employees. If you're in business, probably generally recommend using a software such as Xero or the others to record and substantiate your claims. But this is a really good one for work-related expenses. So please have a look at this. But the main thing is that in terms of substantiation, the ATO want to know that you've actually got a receipt or proof that you've spent the money, you've actually incurred it in the event of an audit. If you scroll down, Laura. Sorry, go up. Go up. Actually, no, that's fine. Anyway, have a receipt. If you don't have a receipt, have a record of it. So get in the habit of paying from your bank statement or your bank account, so it's identifiable on your bank statement. If you get asked, you have substantiation, no problem. As long as it's in relation to the earning of your income, you should be good as gold. All right, next. The other mistake people make when preparing for their tax return is actually not maximizing everything they can claim or what they're entitled to. So it's one thing being risk averse and making sure you don't get any ATO attention, but also you should be claiming what you're entitled to. The ATO actually have a link, which I'll get Laura to bring up, which is industry or occupation specific. Bring that up, Laura. Yeah, so clients always come to me and say, hey, what can I claim? What can't I claim? Look, we're not a library of deductions and wealth of knowledge for every single industry. So we generally give people guidance, but if you want specifics, if you scroll down, there's rules about deduction claims, there's industry specific codes and what you can and can't claim for each. So please have a look at that, look at which industry occupation code is relevant and go from there. We do provide a checklist each year to clients for common deductions. Obviously, it's not exhaustive, so we do our best to sort of customize for everyone because we can't have a checklist for each specific industry or situation. So my advice is to have a look at this link and make sure you're thorough there before you get your tax prepared. This year, the ATO have also voiced that obviously off the back of COVID, people were claiming a lot of home office expenses during that period. So now that people are going back to work, there's going to be greater scrutiny on work-related expenses in home office. So you got to make sure that one, you're entitled to claim, and two, you're not making things up. So in terms of the COVID set rate period to 30 June 2022 this year, there has been an 80% per hour claim method or shortcut method, fixed rate. So that's expiring on 30 June 2022. They're out of lockdowns and people are now moving back to work. A big mistake that people have been making is trying to claim the 80 cents per hour plus phone, internet, depreciation on furniture, equipment, etc. The reason why it's an 80% rate is because it's already been built in, like I guess a buffer for all of that. So it's all inclusive. So as long as you've got a dedicated workspace and you have a diary of how many hours you've worked from home, you can claim the 80 cents per hour. The alternative is using the 52 cents per hour method, which allows you then to claim phone, internet, equipment, depreciation on top. So which method actually ends up being the better of the two requires analysis. So we encourage clients to give us their hours, give us all of their claims in addition, and then we'll do a bit of a cost versus benefit on which is the better outcome. Motor vehicle claim.
Jump in for 1 second.
Yeah.
So this is a really big, I guess, question that I get asked a lot of as well around the 80 cents per hour rule. And what is an easy way for someone to work out, because we've got people that will be watching this recording that are not necessarily clients. So what is the easiest way for them to compile the information to know which method is better?
One, tracking all of your hours in a worksheet or a spreadsheet or a diary. But then in terms of what's better, it's probably a bit hard to tell you now over this session how to do it, but we need to look at all depreciable equipment that are rolling forward, their phone claims, their internet claims, what percentage of that are they actually using for work purposes, documenting that, and then doing the 52 cents per hour based on the hours in addition to the percentage work use for the other expenses, and then doing literally a side-by-side analysis of which gives a better outcome. We don't get clients to do that. We sort of do that as part of the scope of the work. Hence, we just say, look, document everything, send it through with your checklist, and then we'll make a determination on that. But I get a lot of questions after the fact saying, well, you know, I've claimed home office in the return. Where's my phone? Where's my internet? Well, you can't double dip. You either use the 80 cents or the 52 with the additional expenses on top.
Beautiful. Thank you.
Okay, where were we? Motor vehicle claims. So it's been quite interesting seeing what clients are trying to claim over COVID lockdowns. Motor vehicle claims, obviously a big one. People locked down, can't use their vehicle for work. So obviously the ATO is looking into vehicle claims and people who are obviously working from home versus at work. If you're working from home, there's going to be minimal or nominal vehicle cost to claim. So you got to be super careful on that front. On that note, with vehicles, logbooks and diaries required for claims. So people, again, just say, let's do the maximum. There's no such thing as maximum. If you want to claim up to 5,000 kilometers travel, and this does not include home to work, work to home, it's only employment related whilst you're essentially on the clock working, earning an income. For example, you could be a consultant going from site to site, or going to a different work location for the day, being sent there by your employer. We can claim 72 cents per kilometre, provided you have a diary of those travels. Or if it's a very high business year, such as a BDM or a salesperson that you're always on the road, do a logbook, 12 weeks. We can give you a sample of what that looks like after this session with the recording. Come back to us with a business percentage with the logbook, and then we can apply that percentage across depreciation for vehicles, running costs, insurance, interest if you have a loan, etc., etc. So very important logbook, big one. Again, to reiterate, there is a myth out there of just claim whatever you can is the maximum. There actually is no such thing. One exception is the $300 without receipts. So the onus is still on the client to prove that the expense is deductible and that they've incurred it, but do you have to provide a receipt? No. So the $300 limit is still applicable, but be careful of copy and pasting. So if you claim $300 every year, look, the ATO is probably not going to chase someone for a $300 deduction. Don't quote me on that, but it can happen. So if you copy and paste every year, they might just set an example of someone doing that to deter people from doing that moving forward. Okay, another one is individual tax returns. So 30 June, 1 July, I get a famous email from someone saying, hey, can you do my tax yesterday? The 30 June hasn't even ticked over, or it's 1 July. Not recommended. ATO pre-filling or their data matching systems are not updated until probably end of July, start of August. We utilize a lot of that information to pre-fill our returns. It has income such as investments, dividends. Now it has crypto warnings, pre-fill warnings. So if you've gone outside deductions or the norm for your occupation the year before, it will flag a warning for us to look into it. We are, as a practice, probably not going to start any personal returns until August. Our industry bodies are recommending the same. If there's errors or things aren't provided by the client, where we're not just relying on pre-fill, it can create unnecessary admin or amendments in the future. So big one, just be patient. Try not to rely on your tax return as a savings function for your year. Work on your cash flow instead, and we'll get your return done August onwards.
Awesome. Is there any sort of questions from anyone around, common mistakes, or if you have, does someone have a specific question about their own tax or their own business or anything like that that they would like input on? If so, feel free to unmute yourself or put it into the chat. If there's nothing there, we will continue on with information around rental properties, because we do have a number of clients that have rental properties. Just give it a couple of seconds.
Any questions, we can also address them after the session, no problem. Just put it in the chat and we'll get back to you.
Awesome.
Cool. Rental properties, so what to look out for. Repairs versus improvements is a big one, versus also replacing assets. So there can be significant differences in the net tax refund position. Especially a client comes, says, oh, I spent $10,000 on rental repairs for the year, thinking they're going to get a huge refund without actually dissecting and analysing what those items of repairs are. Yes, there are genuine repairs. So spending money on defective items and putting them back into their original state is considered a repair expense, which you can claim up front, such as general wear and tear, broken tiles, leaking taps, plumbing, electrical, etc. If you replace a defective asset, for example, an air conditioner, it could be $5,000. That's not considered a repair and immediately deductible. We actually have to capitalize that and depreciate it over its effective life. So the notion of spend all this money on repairs and a rental property is going to yield them a huge refund doesn't necessarily always eventuate. Where was that? Okay. Also, improvements, repairs versus improvements. So, for example, you might have an old property with the vinyl flooring in the kitchen. I know it's been ripped up, needs to be repaired. If you go and repair the vinyl, sure, the money you spend on that is a repair on revenue accounts. You can claim it against rental income immediately. If you go ahead and put in tiles or timber flooring or different floor covering, that's considered an improvement or a superior material. So it's not just putting it back to its original state. It's actually improving the property or the asset, which again, we need to capitalize and depreciate over its effective life. So there is a big thing there with the ATO looking at repairs and maintenance section in a tax return, people putting thousands and thousands of dollars in there as a claim, likely to be reviewed or audited or questions asked. So you got to make sure that you're distinguishing between a repair, improvement or replacement asset. Another one is apportioning expenses for the weeks available for rent versus the weeks the property was actually rented out. So for deductibility purposes, as long as your property is available for rent, it could be vacant the whole year because you just can't get a tenant in there. I don't know, maybe overpriced, people don't live in the area, whatever it is. If it's available for rent for the entire year, then generally all the running costs and expenses continue to be deductible. Hence, it's really important to ensure that if you're going to continue to claim deductions on a rental property, it is available, it's being actively marketed, and it's not closed and not ready for a tenant to go in there. So that's a big one as well, apportioning expenses. Okay, in terms of maximising your tax return for rental property year-end, some people aren't aware that you can claim depreciation on your properties. There were changes in 2017 about new properties versus old properties. I'm not going to get into that today, but the rule of thumb is if you've got a fairly newish property, building allowance can last up to 40 years, which can be a significant deduction each year. And also internal fixtures and fittings and other plants and chattels can be also revalued by a quantity surveyor in order to increase the depreciable amount for the property, even if secondhand, especially pre-2017. So there could be a lot left on the table there if people don't consider getting a QS report. The reports vary between $400, $700, but there could be thousands of dollars left on the table if you don't consider doing so. And this does not have to be done by 30 June. It can be done later on when you're preparing a tax return. So it's not a time critical item per se.
Awesome. Thank you for that. It is the rental properties is definitely an area that I see that there's lots of confusion. And if anyone has any questions around how it applies to them, feel free to reach out and we can answer those questions. Thanks, Michael.
No probs. Another one. So digital assets, crypto. And I've just thought of something that I haven't got in my notes. So obviously the market's in a bit of shambles at the moment in terms of where things are at. Crypto has been devalued massively compared to where it was at. Pre-30 June strategy, if you were thinking of getting out of the crypto market anyway, and you're a bit nervous, this is not financial advice. This is a tax session. So I'm not telling you to buy or sell investments. But if you had made considerable gains through trading at the start of the financial year and you're looking at disposing of your crypto anyway because you want to get out, good time to crystallize losses is before 30 June to offset gains you made early in the year. So the timing of trades within a financial year is very important if you want to reduce your capital gains. On that note, there's a misconception that if you don't cash in your digital assets, so if they stay in your wallet and you haven't actually transferred it into a bank account in ordinary currency, that there's no capital gain. It's actually false. As long as you're trading the crypto, regardless of where the actual value is sitting, if you've traded that crypto and made a gain or a loss, you must disclose it. The ATO is super efficient and effective these days as a watchdog. Essentially anything that's attached to your TFN is on their file. So like I said to you earlier on in the pre-fill section, when we do a pre-fill for a client, it does warn us in there saying that the client has had crypto trades. Make sure you disclose it. If not, you will get a letter from the ATO asking questions. So yeah, in essence, make sure you declare all your trades to us so that we include it in your return, losses or gains, both.
Beautiful.
Yeah, so there's been some changes in super and updates, some that are recent this year and from 1 July. Laura, did you want to take over? You have Delaney or someone
Yep,
discuss
absolutely.
superannuation?
So we're going to just move slightly away from the deductions and that sort of thing. And what we're going to do now is have Delaney talk to us about super changes for you personally, but also if you have employees, and what some really important reminders around dates for things.
Cool. Hi, everyone. So a couple of things. For a superannuation, if you're an employer and have employees, or you're on your own payroll, only superannuation physically paid and cleared into the super funds by the 30th of June can be accounted for as an expense. So if we want to, quite often when we do monthly or quarterly, more often superannuation, we pay them once the quarter's over. You should, if you work directly with us, you should have heard from your team member. But it could benefit from paying those amounts earlier, because it means it then becomes an expense in the 21-22 year, which reduces your profit, which can reduce your tax a bit. Obviously, if you're in a, if you're not making huge profit, it might not be beneficial, and also you might not be able to pay it a little bit ahead of time anyway. There might be cash flow concerns to take into consideration. So paying that early can be helpful, even if it's just, say you've done April and May payroll, you can pay them early. June can be done in the new year, just to maximise that. Also, there is the maximum, the cap for how much superannuation you can pay in a year, so the 27,500. So if you're a director on your own payroll or whatever, you look at topping up that if you've got the cash flow, to ensure that you make the most of that super contributions you can make. So they're quite time sensitive, because we want to make sure that that is done by the 30th of June. However, it does take about a week to sort of filter through the various super clearing systems that are available. So we're telling everyone that we want everything sort of physically done, paid, approved, whatever needs to happen by the 20th, 21st. So those funds are on their way out of your bank account and waiting to end up in the super funds. So that's kind of time critical that we're getting that done in end of this week, very early next week if need be. So that's some time critical stuff. Also new stuff that's happening from July 2022. So the superannuation rate is continuing to increase a little bit each year. So it goes up from 10% to 10.5%. If you're processing a payroll, it's really important to ensure that the increase is based on the payment date. So if you've got payroll systems set up where you might be paying for a week or a fortnight, but then the payment date's a few days later, which is standard to give you time to process the payroll, you need to increase that. Systems like Xero, last time there was an increase, automatically updated, so we would presume that would be the same. Some of the other ones needed to be manually, just a default setting updated. So firstly, there's that change, the increase to 10.5%, from 10% to 10.5% for super. They're also scrapping at the moment you only get superannuation if an employee is paid $450 a month or more. That's being scrapped, so everyone is eligible from superannuation from the first dollar. There's also a change to do with super workers. So super's available for all ages, but I believe they have to have worked a minimum of 30 hours for it to be kicked in. So there still is probably an area of employees where super's not payable if they're not working those hours. But that's only, Laura, correct me if I'm wrong, that's only for under 18s, isn't it?
That's right, it's for under
18 and over, no matter how many hours you work, you get super on that first dollar from now on.
Correct.
Yeah. So they're the main changes that will be coming into play for the new financial year.
Beautiful. And Michael, did you want to just talk to the SMSFs for anyone that has an SMSF?
Sorry, I need to unmute myself first. Yeah, I'll get onto that in a moment. Also, concessional cap. So concessional contributions, for those who don't know, super guarantee, salary sacrifice, or personal contributions you make outside your salary, out of your pocket, to a super fund where you claim a tax deduction. So this financial year, that's increased to 27,500 from 25,000, which means for tax planning, there's more scope to put in monies into super at 15% versus your marginal rate. Also, the non-concessional cap, so after-tax contributions that you make that you don't claim a tax deduction for, has gone up to 110,000 per financial year. You can trigger a bring forward rule of 3 years, so doing 330 in the 1 year if your balance is under 1.7 million. So that's pretty handy. People want to top up their super come 30 June or post. With SMSF, so if you have an SMSF and you've got for example, I've got a couple of files this side of June where the client's made significant capital gains and they're not intending on putting any money into super in the future, you can actually do additional contributions above the 27,500 cap under a suspense account in SMSF if your deed allows it, which means that essentially rather than doing the 27.5, you can do 55,000 in this financial year. But what happens is we put 27,500 into a suspense account in the balance sheet of the fund, and then we reallocate the 27,500 against the members' balance post 1 July so that it actually goes into their cap for the next financial year, but you get a full deduction for it this financial year. So very handy if you have other income to offset.
Beautiful. SMSF super self-managed super funds, for those of you that may not have them, that's what that means. So there's a lot going on in the super space, and I would absolutely reach out if you have any questions or you're unsure how this relates to you. We're going to jump into the instant asset write-off.
Okay, so during COVID, the former government were kind enough to give us stimulus packages. So obviously part of that was accelerating depreciation. So what they did, they created a temporary full expense depreciation write-off provision, which was supposed to expire this June, but it's been extended to 30 June next year. Essentially, for business assets under capital allowances, this excludes buildings. There has to be under capital allowance provisions. You can temporarily expense the entire cost of the asset in the one financial year on most assets. So that's pretty handy if you've got a good profitable year where you want to defer some of your tax. Claim it all up front before 30 June. Has to be paid for and installed ready for use before 30 June to claim it this year. The only exception to that is the motor vehicle deduction limit. So for depreciation purposes, no matter what you spend in terms of the value of a vehicle, you can only claim up to circa 60,000. It's actually 59, don't quote me, 260 or something, where you can only claim up to that limit. So for the full expense write-off, you can't claim a Ferrari for 400 grand. You can only claim up to the 60. So there's a limit on that. There is a caveat further on vehicles. So what I wanted to address is the aggressive marketing during COVID to buy assets, buy vehicles, spend to drive the economy. That's all great, but clients did that without talking to us. So what they don't understand is fringe benefits tax. So it's all great to buy equipment and get a tax deduction, but if it's predominantly private use, there's fringe benefits tax that could be applicable on the vehicle, which is a nasty tax at the highest marginal rate. So unless you talk to us and get our advice on whether it's actually worthwhile buying the vehicle, and if you've got a valid logbook, again, caveat on that, we need to do the numbers and crunch it as to whether it's worth it versus not. So it's mainly designed for predominant business use vehicles, and it can be very effective in reducing your tax.
Michael, is it, so no other asset category other than motor vehicles have a cap on that instant asset write-off?
No. Temporary full expenses, no, there is no limit. It's as long as your turnover is under 50 million, only vehicles have that cap.
Okay, great.
Next, so the final, I guess, point I wanted to cover off on this session is in relation to trusts, family trusts, discretionary trusts. So over the last 10 years, there's been enormous changes to tax law within trusts. So there was a famous case called the Bamford case, which was approximately 10 years ago, I believe now, which set a precedent on how it's important to have a properly structured trust deed. So a trust is usually established for one, asset protection, and two, an ancillary tax benefit. In order to get a tax benefit or to carefully plan to get that benefit, your deed needs to allow for the planning. So what I mean by that is, in the Bamford case, basically the court of law determined that the deed itself, or the deed that you've got that governs your trust, defines what income the trust can distribute, or defines what income is and how you can distribute that. So what I mean by that is if your deed basically says income is according to ordinary accounting concepts and it doesn't refer to the Income Tax Act, it doesn't have provision there for franking credit streaming. So franking credits is basically tax credits for dividends you receive from a company where the tax has already been prepaid, could be 25 to 30%. If your deed doesn't allow streaming of dividends, you may not be able then to tax efficiently distribute those franking credits to, for example, a beneficiary on a lower income bracket and get refunds from that. So there's a big urgency around looking at trust deeds, how it defines income, how you can stream income, because one, any income that is trapped in a trust is by default taxed at 47%. So if your deed doesn't allow or doesn't define an income in there where you can't distribute it, the trustee is taxed at 47. If it doesn't have provision for capital gain streaming or franking credit streaming, again, you may be proportionately distributing the income, which is ineffective or inefficient, which may not give you the best outcome for the group. So in essence, a deed should have a provision or definition of income in there for both accounting concepts and income tax, and it should be able to give you the flexibility as the trustee to define it as you wish and stream the income to give you the best tax effect. So that's one part of the big changes in trust over the last sort of 10 years. The second one is only recent, which was in Feb this year. There's a section called 100A in the Income Tax Act where essentially the ATO have come out with a ruling saying that it's all good to have a discretionary trust and use it to save tax, but moving forward, you cannot distribute to beneficiaries that do not economically benefit from the distribution. So people have been using trusts in the past to distribute to their adult children or family members where they do on paper nominate an amount because the person's income tax bracket is lower, which means less tax for the group, but then the amount carries forward as a liability or an unpaid present entitlement in the balance sheet, which means that the trust is forever owing the money to the beneficiary. So the ATO have said essentially with this new ruling, from 1 July this year, if you're making a distribution to a beneficiary, one, it cannot be predominantly tax driven, and two, the monies must be paid to the beneficiary. Otherwise, if the ATO deems it a Section 100A distribution, the entire amount gets taxed to the trustee at 47%, which is not ideal. Look, there's heaps to talk about on the trust side. Feel free to contact us. We did send out some information probably 4 to 6 weeks ago about reviewing trust deeds and looking at trust distribution strategies before 30 June. So the team will be reaching out and working alongside me to get all that updated for you.
Awesome. Thank you for that. As you can tell, there's just so much stuff when it comes to taxation and end of financial year, and it's definitely the pointy end for us in terms of ensuring that we're supporting our clients. But if anyone has a question that has not been answered now, then feel free to either pop it in the chat or unmute yourself. You can also send an email to tax@thinkbigfg.com.au with any questions that you might have, or reach out to the person who you've normally been dealing with and we can get the information back to you. Do know that we're here to support you, and we want to ensure that we maximize all of the tax that we possibly can, but we, as outlined by Michael, have to ensure that we aren't triggering the ATO to come down on anyone, and that we're not only maximizing, but we're doing it in line with where we know that the ATO are looking and will be creating problems if we don't do things to the T. So thank you all very much for being here. And Michael, was there anything else that you wanted to add before we wrapped up?
No, anything, yeah, just contact the team. I'm still around. I'm still progressively working on files as and when required and when I can. So we're still functioning, working as before. I am on and off here and there. I'm not on email, so if anyone wants to get in touch with me, just send it to the team and they'll let me know and we'll go from there.
Beautiful. Thank you everyone so much for being here, and we hope that you have a great end of financial year and that the new financial year is even better than what it has been. All right. Thanks, everyone. Have a great day.
Cheers. Bye.